Today, the DFA Daily to the 16th of June 2021. Hi again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest property stats, discuss whether Australia's economy is in a triple crisis, New Zealand's mortgage crisis, and let's look at some more rubbish being spruked by those who should know better. The ABS says that the total value of Australia's 10.6 million residential dwellings rose by $449.9 billion to $8.2 trillion in the March quarter 2021. This was the largest rise on record of this series, and the mean price of residential dwellings in Australia was $779,000, up from $739,900 in the December quarter. The ABS said that the total value of residential dwellings in Australia surpassed the $8 trillion for the first time, and New South Wales accounted for approximately 40% or $3.3 trillion of Australia's total value of dwellings. The average price of residential dwellings in New South Wales rose to $1.01 million, and this was the first time any state or territory has seen the average price of dwellings rise above $1 million. Residential property prices rose 5.4% in the March quarter, and that was the strongest quarterly growth since the December quarter of 2009. All capital cities recorded a rise in residential property prices in the March quarter, led by Sydney, up 6.1%, Melbourne, up 5.1%, and property prices also rose in Perth, up 5.2%, Brisbane, up 4%, Adelaide up 4%, Canberra up 5.6%, Hobart up 6.1%, and Darwin up 4.7%. Results this quarter, they say, were consistent with housing market conditions. Strong demand for housing was supported by record low interest rates, government incentives, and rising consumer confidence. Price rises were observed in all segments of the housing market, with growth in house prices continuing to outpace growth in attached dwellings, they said. House prices rose 6.4%, while attached dwelling prices rose 2.7%, and the rise in house prices this quarter was the strongest since the series began in March 2002. Annually, residential property prices rose 7.5%, with rises in all capital cities, and the largest annual rise in property prices was in Canberra, up 10.9%, followed by Hobart, up 10.2%, and Perth, up 9%. But Australia's runaway house prices are making the national economy less stable and lowering productivity, according to research that warns home ownership is now out of reach for anyone under the age of 35 as governments repeat failed policy fixes. Special research, led by the University of New South Wales, finds that the property market is now a triple threat to the nation's economic future, with the ongoing surge in prices creating economic instability, diverting money away from more productive pursuits, and affecting the lending policies of the nation's major banks. Australia's runaway house prices are increasing economic instability and contributing to slowing productivity, new research, led by the university has found. A system that raises housing costs for all Australians, that raises instability and lowers productivity, does not serve the nation well, said the researchers headed by the university's City Futures Research Centre's Duncan McLean and Hal Pawson. And as for rising housing wealth, it's not like the wealth created from effort and innovation, for that creates gains for all. Rather, it makes some Australians, the affluent and older, better off by making younger and poorer Australians and also future buyers worse off. House prices globally have accelerated since the middle of last year as government stimulus and record low interest rates have been funneled into property markets. Melbourne's median house price has reached $908,000, while Sydney is now at $1.2 million. And the Reserve Bank has said it is focused on keeping interest rates low to drive down unemployment. Governments have pumped money into various policies aimed at first home buyers, including, in New South Wales, an offer of a $25,000 grant which replaces existing stamp duty concessions. The UNSW research, based in part on a survey of the nation's leading economists and housing policy experts, suggests such an approach would do nothing to make homes more affordable. It found that since the mid-1990s, house prices have outstripped income growth, contributing to a 4% drop in national home ownership, heavily concentrated on young people. Home ownership levels among under 35s have halved since 1995. In responding to housing economics evidence, Australian housing policy actions seem to perfectly meet Einstein's test of madness in repeating the same actions and expecting different results, the researchers said. A federal royal commission into Australia's housing future was required, they recommended, given how few coherent policies are in place across the country to deal with all the factors behind the surge in house prices. Our love affair with housing has driven prices to record highs at a potentially huge cost to the nation's economic future. The National Cabinet of state and federal leaders set up to deal with the coronavirus pandemic should have a permanent housing committee to deal with policy coordination, they said, while the federal cabinet should have a specific minister responsible for housing policies and outcomes. All governments should end stimulus measures aimed at the market and instead focus on the social rental sector. And the researchers also recommended the Reserve Bank's mandate should be expanded to include maintaining a more price-stable and well-functioning housing market. The Reserve Bank of New Zealand was recently directed by the Island government to take into consideration the housing market. And the major issue identified by the research, which was released on Tuesday, is the level of household debt. Australians are among the most indebted in the developed world, and the researchers said the rise in debt increased national economic instability. Australian Bureau of Statistics data shows that the average new loan reached a record $635,300 in New South Wales in April. That's an increase of $35,000 over the past 12 months. And in Victoria, the average new loan is now $525,000, up from $488,000 in April last year, while the average loan for a first-time buyer is at a record $451,500. Residential investment can crowd out investment in more productive activities and lead banks to prioritise lending to housing consumption and rent-seeking investment with no positive feedback into economic productivity, the researchers said. And another issue is the growing dependence on the bank of mum and dad, with the report noting that the chances of young people being able to buy homes was increasingly dependent on the financial status of their parents. And in a separate report into the global housing market released on Monday, the OECD said house prices across much of the developed world had grown so fast and by so much that they were eating into the ability of households to pay for other essentials such as health and education. It found Australian house prices had experienced the fourth largest increase in after-inflation prices across the OECD, up by 120% between 2000 and 2020. Only New Zealand, Canada and Sweden experienced bigger increases. House prices have typically risen faster than average incomes, and households have borrowed more and more to buy their home, so that the burden of mortgage servicing has become heavier for many households despite lower interest rates, it said. And the OECD said prices for Australian housing, which ranks second only to the United States in terms of its adverse environmental impact, was being pushed up by a lack of supply and restrictive land use laws. Restrictive land use governance criteria that depends on too many categories and excessive prescription on allowable activities have played a role in limiting land supply, it said. And also this from news.com.au. Australia's economy is in a triple crisis, prompting calls for a royal commission into the future of housing. The reason why? Because Australia's property market is going so well. When the pandemic broke out, economists warned prices were going to fall 20 to 25%. Now we're seeing prices rising 20 to 25%. Chris Leishman, Professor of Property and Housing Economics at the University of South Australia, told news.com.au. The fact that commentators switch their predictions so quickly shows how unstable the housing market is. The new report, published on Tuesday, of which Professor Leishman is one of the main researchers, found banks and the government are responsible for fueling the frantic housing market. The report, titled Housing, Taming the Elephant in the Economy, interviewed a panel of 87 experts and has been a year in the making. Among its findings were that the number of homeowners under the age of 35 have halved since 1995, with most properties concentrated in the hands of 65-year-olds or older. Professor Leishman said he is seeing evidence that people under 35 are given up on buying a house as a result. According to the research, the home ownership is now out of reach for any Aussies under the age of 35. Australia is one of the most indebted developed countries, beating the US, UK and Canada. The inequality gap is widening as the housing market continues to surge. Australia's houses are taking on average just 32 days to sell as the economy recovers from COVID-19. And the housing sector is fueling a problem threefold, creating an unstable economy, generating inequality, and perhaps most surprisingly, reducing productivity. When the economy is booming, we see housing prices accelerate. That's the bit we already knew, Professor Leishman said. In the report, we actually asked the question, is there a feedback loop the other way around? And they indeed found a reverse feedback loop. Expensive houses are driving young professionals from the city into the outer suburbs or the regions to afford a house. As housing markets get more and more expensive, more productive workers are displaced, Professor Leishman explained. The report's authors are calling for a royal commission into housing and to expand the Reserve Bank of Australia's responsibilities to include house prices. We think the RBA's remit should be wider. It should include the housing market, Professor Leishman said. And he's particularly concerned about interest rates, which are currently at record lows. It wouldn't take very much for a shift in interest rates to cause a great deal of harm in the housing system, he said. The report wants housing stimulus packages to switch from housing to the social rental sector while the market is re-evaluated. And the report's lead author, Professor Duncan McLean, said something needs to be done. The recent explosion in house prices brings a fresh and troubling dynamic, he says. Rampant price growth has returned to the larger cities and is now spreading to regional Australia. This is in part due to the pandemic-fueled work-from-home revolution, but is also because so many younger Australians can no longer afford the life they want as homeowners in the larger cities. And the report wanted to draw attention to the elephant in the room when it comes to buying a property. The housing system elephant is not only a beast now poorly grasped by policymakers, it is also one which is rampaging through the economy, it read. Well, good on them for calling out what I've been saying for so long, and I would just wish that the regulators and policymakers would take note. But I doubt they will, because they have a very narrow agenda, predominantly trying to get re-elected at any cost. Now, over in New Zealand, many New Zealand mortgage holders who put their repayments on hold during the COVID-19 lockdown have struggled to pick them up again, according to new data. Credit bureau reporting Centrix analysed the data in its credit files to reveal that while the mortgage deferral scheme has been an overall success, many households had not been able to resume repayments successfully. More than 1 in 4 mortgages that participate in the mortgage deferral scheme in New Zealand had either been closed, dealt with under bank hardship provisions, or moved to interest-only repayments. The closure of the mortgage accounts indicate that homes were likely sold and the mortgage repaid, or they have closed their account and have sourced alternative finance, said Centrix Chief Executive Keith McLaren. Centrix compiles credit reports on everyone in New Zealand with data passed to it by the likes of loan companies, banks, insurers and power companies, all of whom require people signing up with them to consent to the data sharing. The data it collects gives Centrix a helicopter view of the nation's borrowing habits and credit ratings, but it also means Centrix has the data to gauge the success of the mortgage deferral scheme, which was created by the Reserve Bank and the mainstream banks to allow homeowners to reduce or temporarily halt loan repayments to give them the chance to bounce back from the economic disruption caused by the COVID-19 pandemic. Overall, the deferral scheme was successful, with nearly 3/4 of deferred mortgages able to move to principal payments, McLaren said. Some homeowners who ran into financial trouble during the COVID-19 economic downturn may have sold their homes, data from the Credit Reporting Bureau suggests. Though the economy has fared much better than bank economists had initially expected when national lockdown was announced back in March 2020, the scheme may not have been enough to save many homes, whether owned by landlords or owner-occupiers. McLaughlin said that 73% of home loan borrowers who were granted mortgage deferrals by the banks had now resumed full principal and interest repayments, aided by low mortgage rates, which followed close on the heels of cuts by the Reserve Bank to its official cash rate. But 10% of home loans which went into mortgage deferral were still on interest-only repayments at the end of May, and a move typically adopted by homeowners only when they could not afford full repayments. A further 3% of home loans which were under mortgage deferral and a further 3% of home loans which were under mortgage deferral schemes were shifted into hardship management by banks and remained there in May. In addition, 14% of home loans that were once under the mortgage deferral scheme have been closed, he said. That could mean one of two things: that the home had been sold and the home loan paid off, or that the borrower had refinanced their home with another lender, resulting in the closure of their original home loan account. Government changes to property investing rules designed to tip the balance back towards owner-occupiers may have played a part in slowing the number of home loan applications in May, and mortgage applications remain strong in May, but are down from their February peak, they said. It's too early to know whether this weakening is reflective of low winter demand or the impact of government housing policy, he said. Personal loan volumes, though, were up 7% on the prior month, but were still well below the pre-COVID baseline level. And new credit card applications also remain weak at 60% of pre-COVID baselines. This indicates that consumers are exercising greater caution before taking on high interest credit, they said. Now, this is an interesting article, which is again a bit of a spruik. The Australian apartment pipeline is set to fall, raising worries about rental shortages when the borders open. According to Knight Frank, only 86,400 new apartments are tipped to be in the pipeline by 2024, compared with 135,300 from 2018 to 2020. Knight Frank Research's Australian Residential Development Review in 2021 found. After the building boom of recent years dropped off, property developers have been keen to buy up sites for new apartment projects, but then the pandemic hit, Knight Frank's head of residential research, Michelle Chesecki, said. When COVID came through, that did put the brakes on, she said. In the past, where developers would have been quite keen to buy a raw site without development approval, they started to switch to sites that had approvals to take away some of the risk. There weren't many sites that were suitable, and there was a bit of hesitation because there had been so much uncertainty in 2020. Total residential sales fell to $4 billion in 2020, down from a peak of $11.3 billion in 2014 and lower than the $5.03 billion in 2019, the research found. The smaller pipeline could have a flow-on effect in coming years, she said. Although CBD apartment towers have emptied in the pandemic as international students and migrants were banned from arriving, pushing rental vacancy rates up, this could reverse once vaccines roll out and international borders reopen. We're not likely to get a boost in population over the next 12 months, she said, but if we fast forward to 3 years' time when population growth has switched back on again, we're starting to see more people come back to Australia. We're not going to have the apartments to accommodate these people. A diminished pipeline of new apartments could also help sustain value, she said. People will start to realise there isn't much to choose from, and that reflects the pipeline tapering back over the coming years, she said. Values could be sustained by that instance. The shrinking apartment pipeline is evident in the larger capital cities. In Sydney, only 36,275 new units will be on the way by 2024, down from 67,925 between 2018 and 2020, the research found. Projects could face higher building costs in the New South Wales capital and competition from state and federal government infrastructure projects for supplies and labour. For Melbourne, the new stock will fall to 34,250, down from 42,250 over the same time period. New buildings there would need well-being elements such as gardens and dry and wet exercise areas after residents' long periods confined to their homes, she said. But Brisbane's pipeline is all set to halve, but the picture is also a bit more upbeat on the Gold Coast, where the value of apartment sales tripled last year amid keen interest from first home buyers and downsizers. Although the Perth unit pipeline is also set to fall, rental vacancy rates have been tighter on the West Coast, and sales of established apartments are rising as the resource-focused city's economy strengthens. More broadly, the type of apartments being built are changing, with owner-occupiers starting to replace investors even before the pandemic. Traditionally, investors are keen for a smaller stock, but in a post-COVID-19 world, rental stock possibly can't afford to be small anymore because people are looking for larger living areas after an experience of lockdown, she said. Even though developers have adapted and started to build more owner-occupier stock, I think we'll find in coming years investors will be looking for that stock as well, and developers are increasingly buying sites for low-density projects instead of mega towers, with the share of sites sold for the former option rising from 10.1% in 2020. So 3 quick points to make. Firstly, of course, they're spruiking building more high-rise. We don't need it. There is plenty of spare capacity. That's just a spruik. Secondly, the broader point about the research is exactly right, that the property market has been skewed badly by poor policy for many years, by very low interest rates, and that is putting unbearable pressure on many households, as reported in our stress, and also, of course, people are unable to enter the market. But unless we get joined up thinking between state and federal, and unless we get a real focus on long-term strategic intent in the sector, things will just go on. And of course, the simple lever that they'll have is to open up the borders and power housing and property with more migration. But that won't solve anything. That will just kick the can down the road once again. Time to recognise the elephant in the room and to tackle it strategically. Well, I think so. Pity that most politicians can't see the elephant. Maybe they have their eyes closed. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.